Okay, my name is Mark Mosley. I've been a trader for about 15 years. I have played around with almost every strategy you can imagine, and I'm just here to talk about what I've done and kind of my latest thoughts on trading. And so I've done maybe, I think, 6 prior presentations for the group that
Thank
that
you.
uh,
Which thanks.
hopefully Don will post the link somewhere, but we'll just get right into it. We'll just get right into it here. Okay, so I've kind of settled on the notion of directional trades, and I'm going to skip over that. Okay, so there's a notion in the trading community about non-directional trades, which are pretty popular because they can be employed with little reliance on technical analysis or any sort of analysis. Most of the non-directional trades essentially straddle the at-the-money pricing on your underlying, and it's typically done on the S&P 500. But some people do it on large stocks like Netflix. Um, but the idea is no real technical analysis is required, that we have such a huge profit tent that uh, we hope to stay underneath that profit tent. And so I've done 2 previous videos on this. The 2040-60 net zero butterfly we'll talk about a little bit. Then also something I played around with is uh, a large calendar spread with the short leg at about 60 days and the long leg at about 90 days. And we'll discuss that a little bit too. Um, okay, so some of the drawbacks to direction neutral trading, there can be a large margin requirement depending on the payout you're expecting to receive at the end of the holding period. So the risk to reward is, can be somewhat large. Also, large moves in the market can take you out of your trade or require you to adjust. So when I was doing these, wasn't too unusual to sit on a trade for 3 weeks or a month and then have to close for a break even or maybe even a loss because of a huge move in the market. So then you've lost a month of time while you're waiting for theta to accumulate in your trade. So that became a problem for me. Let me see. Yeah, big moves can force you to exit trade after sitting for weeks. Anyway, here is an example of the 2040-60 net zero butterfly. And I'm assuming everybody can see my cursor. So the at the money would be right here. And if you're not used to reading these charts, we have the potential pricing. In this case, it's the S&P 500, but as you know, this on your typical price graph would be the vertical axis, but on the Analyze tab in Thinkorswim, it's the horizontal axis. And so, normally price can bounce around here, but I would put these on, and you'll notice the large sea of death down here. So that's your max risk in this trade, and this one is just a one lot. Let me see if I can hide these things. Okay, this one's just a one lot, and oops. And so if there was to be a big move down in the market, you could easily wind up over here losing thousands of dollars, and that's not what we want to do. So you would have to make an adjustment or close before you went too much into the negative, which would be somewhat in this vicinity. Now, the market typically grinds up and then will pull back and grind up and pull back. So the problem I was having is it would run off the top also, either the bottom or the top. And it seems like this is a huge range. In this case, I set this up over the weekend, but it would appear we're safe from about 6,200 to 6,500, and all it takes is a news story or something, and we're blowing out one way or the other. So I did these, and these are also typically placed about 60 days to expiration. So that's a long time to hold a trade. Even if you're exiting early, you're still talking maybe 6 weeks holding this trade to make money, and you're likely to have a big move in that period. So that was our first experiment in direction neutral trading. And then I came up with these 60, 90-day calendar spread. And you'll notice a similar big tent. It would appear that we're safe from about 62.50 up to 60 way up here anyway. But just like the other one, that's a long time to hold a trade. This is 60 days to expiration. Typically you might exit these with 2 weeks to go before expiration. And that's a long time to sit in this thing. And at the get-go, it would seem, oh, what a great range that you have. But things happen, and first thing you know, you've been fooling with the trade for a month, and then you're forced to either close it for a break even or start adjusting, which ramps up the risk, the money in the trade. So that was a problem with that, and I had experimented with both of these trades with the idea that this would be a somewhat of a portfolio wide trade, that you could sink whatever the number is, $100,000 into a trade and sit there, and then at the end of 6 weeks, if everything goes right, you would have a nice profit. But and I did well for years with this, but then some volatility came into the market and I started losing, and I said, there's got to be a better way. So moving right along, alternatives to direction neutral trading. I've decided that some level of technical analysis is key to trading in general. And so I'm going to recommend that everybody study candlestick charting and understand what these are. And this is just a piece of clip art I stuck in, to explain all the nuances of candlestick trading is probably beyond the scope of this discussion, but price volume analysis is really where I'm going with this. So you study the candlesticks and you study the volume bars at the base of your chart, and you derive a opinion of which way the market's going. And so again, that's probably beyond the scope of what I can get into. It's much of an art as a science, and I will recommend some resources here as we go. This is a little thing about different candlestick patterns, and you see this stuff play out time after time the more you look at these charts. Now, I think the flow of this is a little bit off, but one of the tools I use is Shadow Trader. Shadow Trader is at shadowtrader.net. They have a really good thing called the Shadow Trader Weekly Options Advisory, and this guy, Peter Resnicek, is very skilled at technical analysis. And this is one of his studies that I'm a big fan of. This is the weighted advanced decline. And what you're seeing here, so the S&P 500 is made up of 11 sectors, and some technology, financials, and healthcare are the three top sectors, which have a huge weight to them. Some of the other sectors have a very low weight. And so what's happening in the top three sectors really drives the market. And so this is actually on a 5-minute chart, but what you're seeing, the overall unweighted measure is the white line, and the weighted is the red and green lines here. And so one way to think of it is the weighted stocks are the more important ones. The unweighted measure is the least important. And so you can it takes a while of looking at this, but you can gain a feeling for the momentum of the stock moves when you have this study on your chart. And this is available from shadowtrader.net. It's about $100. I love it. I use this study all the time, and so that's a little rundown on that. Okay. So my answer for what to do instead of direction neutral is a directional trade. And so I've got several examples here. Now I play these with butterflies or calendar spreads. Now my favorite really is a calendar spread, but I do butterflies too. And this is an example. So if we were bullish on the S&P and we wanted to jump into a trade, this is something you could do. And so I'm positioning the butterfly up above at the money. So this was, I set this up over the weekend. So the S&P was right here at about 63.88. And so, you know, in this example, I was bullish and I said, let's get out in front of where the market's going and have the market gravitate to our profit tent here. And so there's lots of ways to do this. In this case, I've got I positioned the short leg at 64.75, and I did 25-point wings. And you'll notice the shallow downside here. This cost about $2,000, to actually 2,400, to get in this trade, and then with the possibility that you could get up here in the profit tent, and you never hit the peak of it, but you could make $8,000 or $10,000 on this trade when you got 2,400 at risk. And it plays out in 5 days, so there's no weeks and weeks of watching this thing, and you reload based on your analysis of where you think the market's going. And one reason I like it is we're minimizing our risk. We're not risking 10,000 or 100,000. We're risking 2,400, and this could be done even smaller. This is a 10-lot trade, so you could do a 1 lot for $240 if you want to play with this. In this case, now the pricing will be different based on all kinds of things: implied volatility, timed expiration, on and on. But you'll see as price goes up, this is your T+0 line. It goes up, and so that's a rundown on the 5 DTE butterfly. Now I do not put these on just mechanically, like I don't put on a trade on Monday for Friday expiration. I wait till the right setups appear on the chart and then make a decision as to which expiration I want to go with. But that's a little rundown as a way to use a butterfly as a directional trade with a very small risk and a nice reward. And so this is an example of my Friday, Monday calendar spread. So there's an implied volatility edge that if you sell the Friday expiration and buy the following Monday, 3 days beyond, usually the Friday implied volatility is higher than the following Monday. And so so my typical setup is sell Friday and buy Monday. And in this case, again, the S&P was down here at 63.88. Any move to the upside, and we're under the profit tent here, and we got this huge range to work with. And so this costs about, for a 10 lot, about $2,600. Again, you could do a 1 lot or a 2 lot or whatever you want, but the max loss, I like to see shallow here on the downside compared to the height of this profit tent. So in my mind, there's a certain visual thing I'm looking for. Now I do these on Netflix and some of the big stocks, and they pay really well too. Now something like Netflix would not have a Monday expiration. It would be just the weekly expiration. So I'll sell 1 week and buy the next on a stock. But if I'm trading the S&P, I sell Friday and buy Monday. But I'd like to see a really shallow downside down here where if things go wrong, this is what you're going to lose, and big upside here. So for a risk of $2,600, I could make, if things go well, and I watch it really closely as it comes into Thursday and Friday, I could make $10,000 to $15,000 on $2,600 in risk. So this is my favorite trade right here. Anyway, moving right along. Trade timing. Okay. I guess you kind of glean that trades benefit from proper timing of entries and exits, which is part art and part science. And so another approach to technical analysis I'm going to get into here is using exponential moving averages or moving averages. And I'm going to call this the 2-line method. Shadow Trader has something similar they call the 3-line method, which involves the VWAP, volume weighted average. Thank you. So anyway, so I use the 8 and 21 exponential moving averages, and I typically start off with a weekly chart, look for pivot levels, draw some lines, go down to the daily, go down to the 4-hour, and go down to the 30-minute. And so again, this is part art and part science, and it would be impossible for me to lay out all of my experience with this. But here we have a chart that displays the 2 moving averages. So the 8-day is the row of blue dots you'll see along here, and the 21-day is the solid white line. And so we just have a bullish run here in this chart, but you'll see at times the 8-day drops below the 21, and you want to be looking for bearish trades then. But when the 8-day comes up above the 21, you want to be looking for bullish trades. And if you'll look very carefully, you'll see, now this is a daily chart. Each one of these candles represents 1 day. And so if you look very carefully, you'll see the candles somewhat respect this 8-day moving average. Here, these 2 days, the shadow of the candle came right down to the 8, and then went up. And so if we break through the 8, that's another data point. Oftentimes, even if we break through the 8, we'll find support at the 21 though. So typically what I'm looking for is I'm looking for long wicks. Like right here, we have a long wick that came down through the 8 and the 21, reversed and finished on the highs. That's a really bullish candle right there. Even though we tested the 8 and the 21, we finished on the highs, and boom, off to the races. And so, that if you'll look carefully at this chart, there's all kinds of times when the candles came down, touched the 8, and took off. And so, again, as long as the 8 is over the 21, we're looking for bullish trades. And anyway, that's kind of it in a nutshell. So I'm also looking at the weighted advanced decline that we talked before a while ago. If we come down here and I'm seeing weakness on the weighted advanced decline and my other indicators are showing weakness, then I might hold off. But I'm looking for bullish patterns here. And when I see one, I get out in front of it with, typically I do the calendar spread, but the butterfly works too. I really like the risk reward on the calendar spreads, but there's all kinds of times you could have gotten out in front of this big run since April and made some nice money. So does anybody have any questions about this? You can do it on both sides, but historically there's just a natural grind up in the stock market. So typically I just play the upside. Now I don't know. I can't go back to a bearish phase here. Well, typically I'm just playing the upside. If we do roll into a bearish move, I will look to see if it's really going or whether it's just a one-day pullback. Okay, I'm back on a 30-minute chart here. But the same kind of thing works. The two-line method on the 30-minute chart is helpful info too. And you'll notice, even though we're using the same moving averages as we would on the daily, notice how often these candles respect these lines. You can see the wick of the candle come back to the 8 and then take off over and over. But again, I lean towards the long side. There's a natural drift up in the market, and oftentimes the pullbacks are short, unless there's something big going on that is really driving the market down. And then I would certainly get out in front of it with a calendar in the puts on the downside. But anyway. Okay, another tool from Shadow Trader. You'll notice these tickers on the bottom. If you join their trading group, you get this study, and what it shows you is all the different sectors that make up the S&P, and they are color coded. So if it's less than, this shows the change on the day. So when the market opens, they'll all be neutral. But by 10:30, I try not to make any decisions before 10:30 in the morning. By 10:30, you'll start to see these sectors pick a direction. And so the top sectors are infotech, financials, and healthcare. And so this is all color coded too. If it's less than 0.5%, it's light green. If it's more than 0.5%, it's dark green. And same thing on the downside. If it's less than 0.5% down, it'll be pink. If it's more than 0.5% down, it'll be red. So it's a real visual tool that combined, I benefit from visual things in trading. And so this combined with the weighted advanced decline and the two-line moving average, I can look at all this and decide, yes, we're looking strong. Let's get out in front of it. We're also, it's a relatively short-term prognostication. I'm saying it looks strong for the next few days. I'm not trying to make some prediction as to what's going to happen 60 days down the road. So anyway, that's some of my thoughts on that. Again, we have the weighted advanced decline here, and this is a little bigger chart than the one I was showing before. Again, the stocks that matter are the red and green bars, and which would be the primary sectors. And like on this day, you can see how they are stronger than the white line, which is the unweighted measure. So that's a very bullish signal right there when the red and green lines surpass the white line. See that several days here. That's a lot of strength, and I don't know what. Let me see, 728. So this is recent. This is like the last week, and so look at the strength we're seeing right here on this day. The weighted stocks are significantly taller than the unweighted average. That's just really strongly bullish. Now, even after a bullish run, we might take a breath for a day and then we're back to it. And so this is an important piece of info that I really like, and it's visual. We're not crunching numbers or whatever. So anyway, resources for further study. These are just a few things I put together. I'm working on volume price analysis is really my goal. I did not get into the volume bars at the bottom of the chart today because there's only so many different ways to go today, and I'm actually still learning it myself. But there's a great book called A Complete Guide to Volume Price Analysis by Anna Cooling. She is on Twitter also and posts some interesting things. And a few other people that I follow on Twitter. That these are kind of silly names, Thick Teddy, but he's really good. He posts a lot of stuff about volume price analysis. And this Atif Hussein guy, he just today posted like a 4-hour video about volume price.
What? Mom asked if you want to go out and get something to eat or some drinks.
What do you guys want to do?
Sure. Yeah, I'd like to.
Just you want to go now or?
I should 7.
Bring back pizza or something, whatever, you guys want to do that? Yeah.
Let's go.
Okay.
Okay. We just had a few people bleeding in there. So anyway, can I answer any questions here? This would seem to be a fertile area for AI, and I think that would be something great to work on. I am not really there applying this to AI yet, but I would agree. Certainly room for further study there. Okay, in an up-moving trend, volatility falls. How is that affecting the counter position? It really has not been a problem. I don't even really think about that too much. Volatility is more of a factor in the longer term trades. These are so close to expiration that movement and volatility affects the spreads very little in my experience, and so I don't even worry about that. If I think the market's going up, I'll just get out in front of it and don't overthink it. Right. Okay, the question was going back to my original butterfly. It looked like it was a long way from at the money. Well, it was, and what kind of percentage that is. I mean, typically I'm just looking for a 100-point move in a week. Now, is that too much or too little? It's a ballpark guess, really. The market's in a week on the SPX. Now that's certainly, there's nothing scientific about that. If you graph out a lot of these calendar spreads, you'll notice they're much more expensive at the money than away from the money. So if I position about 100 points out, I can usually get them for around $2 or maybe a little more, $2 to $2.50. If you're right at the money, it's going to cost you a good bit more, and so that's ultimately risk in the trade. So, like everything in this business, there are all kinds of trade-offs. So, if you want to make more money, you typically have to risk more, or these are actually considered low probability trades. If you look at the probabilities, it's probably going to tell you you've got a low chance of making it 100 points in a week. But we're not even trying to get to the middle of the profit tent either. If we can just get some progress up that slope, we can easily hit 100% of 100% return on cash invested. So, it's a wild guess, honestly. There's nothing real scientific about that. I try to get them for a little over $2 and go with it. I try to keep my losers small by keeping my debit small. What strikes do you use for calendars? Okay, calendars have the same strike front and back. So You have to decide how far you think the market may go based on your analysis. And I just said, I'm usually picking around 100 points. But yeah, a calendar would have the same strike front and back. You sell the front leg and you buy the back leg. And we're doing this in the calls typically because we're leaning to the bullish side. Okay, does volatility play into? Okay, I already answered that. Let's see what else we got here. How do you decide where you center the profit tent? Well, I talked about that a little bit. We're looking for a move to the upside. I'm just grabbing 100 points. I got into this previously. This is not a whole portfolio strategy where you're going to manage your money in this fashion. This is kind of a gambling kind of thing that you are going to take a shot each week. You're either going to lose, a small amount, or you might. I'm typically playing with. Sometimes I scale up the size, but like I can stomach a $2,500 loss in exchange for a $15,000 win. And anyway, that's my thoughts on that. Let me see. I probably win about 70% of them. So not bad. I'm mainly trading off the question was how often do I bounce between the different time frames. I'm mainly looking at the daily, actually. I want to see how the day is shaping up in relation to the previous day is one approach. I'm looking at these momentum indicators to tell me how strong the market is today. You can sit there looking at it and still not really have a good visual understanding of like how much momentum we've got today. And so that's where the indicators come in. But typically I'm mostly looking at the daily chart. No, I don't. There's so many things that play into that, and it's a inverse measurement too, which is when you're trying to do everything visual, you have to remember the other way. But yeah, I think the weighted advanced decline is more powerful for this time frame trading. So yeah, I don't even have the VIX on my screen. I do on a watch list, but I'm not graphing it. Yes, I've played with a lot of those indicators. My thought is, and some people may do very well with those, but I got frustrated because so many of them. He's talking about the TTM squeeze. I think it has potential. It's really what you get used to using. I feel like looking at the candlesticks themselves is going to give you a better picture of what's going on than trying to look at some third-party indicator that's supposed to be telling me what the candlesticks are doing. So I've played with a lot of that stuff and gone away from it and cleaned up my charts. It's really easy to have too much on your charts.
Watching something. I'm sorry.
Sure. You got a question? Okay. Let me see. Recenter the 10. Okay. Does volatility play when you use calendars versus butterflies? Again, for this short time frame that we're talking about, 5 days to expiration, Vega is a bigger factor when you're far from expiration. So that would have been a bigger factor doing these big non-directional trades. But for 5 days out, I don't worry about that. I just want to get the direction of movement right, and that's the big thing with this approach. So, in an up moving trend, volatility falls. How's it affecting? Okay, I already answered that. Yeah, calendars are positive Vega. So, okay, we can get that. That's a very deep subject. Ron Bertino has done a very interesting video about how the Vega that the brokers are reporting to us is not accurate. And at times, calendars can display properties of both positive and negative Vega. And that's beyond the scope of this talk. But but for my trading, I don't worry about that. So there you go. Again, this would be a great thing to apply AI to. Let me see. Picking your strikes. Talk about that. Do calendars close on Friday or before? Okay. So on the Friday, Monday calendars, oftentimes I close them on Thursday. You can be up nice money by Thursday, and I mean, if you really want to hit a home run, you can carry it into Friday and get lucky, but there's a chance there could be a big move in the market overnight, Thursday night, and you could be up a nice number for the week, and then it all goes away because of a big move overnight. So, um, um, okay, the question is, okay, we're setting up a calendar, selling the Friday and buying the Monday. How far in advance are we getting into this trade? Well, I'm looking for the right setup on the chart with the candlesticks interacting with the 8-day moving average. I would like to see a pullback to the 8-day to get long. You don't want to jump on a breakout. You want to buy the pullback, really. So I'm looking for a candle to come down and touch the 8-day while we're in a bullish trend. And so that's my entry. Now, that could be anywhere from 10 days prior to that Friday up until, I have put them on Wednesday for Friday, Monday expiration. So it could be 3 days out, it could be 8 days out. Right. You really want to look for the right setup on your chart. To just think that you can come in and go, okay, it's Monday, the market just opened, I want a paycheck on Friday, so I'm going to put on a trade. That would not be the right approach. You really want the right setup on your charts. And, some technical analysis, some candlestick reading, some of these indicators I'm talking about can all give you some confidence in that. If we were pulling back to the 8-day moving average on the 30-minute chart, and then I was seeing a breakdown in the market on the weighted advanced decline, then I would not want to do the trade. So you have to get a feel for the strength of the market based on these momentum indicators. Anyway, okay, please. What was that again? Okay, the question was, which moving average do you use, the simple moving average or the exponential? I use the exponential moving average. That's the one I use. I don't know if it would make much difference. Probably not a lot of difference, but maybe a little. So that's what I use. Sure. Right. 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 Correct. Um, Okay, the question was, if I got the gist of this, is if you're trading the butterflies, let me see if we can get back to the butterfly graph. Yeah. Okay. So the question was essentially, okay, we're selling, we're selling 20 in the middle, buying 10 on the wings. You're asking where to put it, how far away from at the money. Again, there's no, just like with the butterflies, there's no exact answer to that. Typically, much like the calendar spreads, the farther away you are from at the money, the cheaper the trade. So I would suggest just get your software out and set some up right at the money. Set some out 50 points from at the money. Set some out 100 points at the money, and then compare the price, the debit for each one, and you'll notice that the ones right at the money are significantly more expensive. And so we are betting on a move to the upside. We're not betting on a move to sit here. If we just sit here, eventually we're going to hit max loss, which is not what we want to do. So I don't know if I really answered that or not. You have to look at the market and make those decisions yourself. Oftentimes in a strong market, I'll just go with 100 points above the money. So 100 points would be your middle of the trade. Yeah, and well, it could come up to the short strike, but then you have to manage your trade. If we moved from, say, right here to the middle right here, this is just this is not a live platform, so I can't manipulate the date. But see, normally you would be able to click here and see how this T+0 line changes over time as the days go by. But let's just say you started here, price moved to up here. You don't really want it going much beyond the midpoint, because then this T+0 line will start to drop off. So you're going to have to make a judgment decision. Okay, I put this thing on Monday. Okay, it's Wednesday afternoon and we're right here. You might pull the plug Wednesday. You might be up some nice money by Wednesday and just doing enough. I don't want it blowing out the top. So there's always these decisions you have to make along the way. I wish there was a solid formula, but this is part art and part science. It may be possible to program AI to do this, but you have to make decisions along the way. You'll notice how much bigger the profit tent is for the calendar versus the butterfly. I mean, they're approximately the same investment, and as I toggle back and forth, I mean, which one would you rather be in?
Also, guys, let's finally the areas on the website because they're going to drop off. And now we got all for 3/4 of an hour afterwards. So let's keep most of our questions here in the room. We're asking and most of the people are on. Go ahead.
Okay, so anyway,
wherever
this question. Okay, so I'm just going down the list, seeing if we have more questions. Okay, some people use expected move on toss. You could certainly do that. But again, with the calendar spread, you don't have to get to the middle of your trade. If you can just make some progress up that ramp, you can easily hit 100% return on your investment, and that's really a nice return if you can do that. Even if it's you're not risking a huge amount of money, but if you can make 100% return on $2,500 and do it in 3 or 4 days and take your money, you're doing pretty good. So, but yeah, you could look at expected move. What else do we have? I think, let's see, the weighted advance is for the intraday. Okay, yeah, that's a good point. Weighted advance decline is for the intraday. But I look at it as a momentum indicator for right now. So, I mean, typically in a move up, the initial move will be strong, and then as the buyers run out, the move begins to weaken. So I'm looking for that, even though that it may be a day trading tool, the weighted advance decline. It tells me kind of, I feel like it's a really good measure of the current momentum. So anyway, what else? AI only understands science, not art. Well, I agree, Ron. That's a good point. But maybe there's a way. I don't know. I've not gotten into automated trading, so there are people much better with that than I. So
I wouldn't count on AI is really not. But I mean, it could be a reducing that side of the market that trade and it would disappear from the point of the market.
well, I mean, the algos are certainly a big factor in the market, and those have been developed by big money people on Wall Street with like really smart guys with advanced degrees. I guess AI trading would not be too different than that, but anyway, that's beyond the scope here. Let me see. We got another. We can't hear Don's comments in the background. We can hear Mark just fine. Okay. He said, let's move along. All right. What else?
Well,
Yeah. Well, the candlestick wicks. Those are candlestick wicks of shadows. They used to do a free show several years ago, and they were, Peter likes he's actually trading some other things, so that might be the shadow. But anyway, there's the shadow of the candlestick. Guy Peter Rosenchuk's really good. He puts out a lot of free videos. We can wrap up every week, but kind of gives take on where we stand, get moving forward, and that sort of thing. So he puts out a lot of free stuff too. You can find his page on YouTube. But if you want to weekly options advisory, it's about $95 a month, I believe. And he typically talks from 9:30 till about noon every day. He puts out a lot of good info, a lot of good trade ideas. I typically follow him for his technical analysis more so than his trade ideas. He does a lot of ratio spreads and things that take larger accounts. So I just look at, if he's, if he puts up a good argument why a certain stock might be in a bullish phase, I'll take a shot and just put a calendar on out in front of the money, like I explained. No. Well, he does butterflies, but he does a lot of ratio spreads and butterflies. Yeah. I think so. There's there's a lot of people that follow him. There's a chat board that you get along with the membership. And anyway, there's a lot of discussion on all sorts of different trading issues and approaches. And I don't really do ratio spreads. I like to keep my risk manageable, and even though I understand that the likelihood of hitting max loss on a ratio spread is pretty small, I just like to keep it simple, you know.
Yeah, I agree with you. So, like, if you have to do a trading, would you expect to find on his call?
Yeah.
Just one source.
He's really just one source. There's actually a lot of good people on Twitter that are posting things about volume price analysis.
Okay.
And the same sort of thing that we've been talking about. Somebody talking here.
Yeah, can you? Okay.
So yeah, so no, I'm not totally dependent on shadow trader. I do like their indicators. At some point I might stop them because really know how to trade. But I've gotten a lot of benefit from their indicators, and but you have to have something, you know, if you're going to do these directional trades, there has to be a basis for your decision of why you think we're going up. You got to have a good argument as to why, or you should, if you're going to commit capital to the idea. But this has been my approach.
Is it your impression that let's say, just you have people just in the underlying?
Oh yeah, oh yeah.
How would you say you're doing relative to people who are just trading the underlying with the same information?
Yeah, I don't really know how other people are doing, but I think they did pretty well. Generally. He's looking for some of the same things I've outlined here. You know, bullish trend when we have the 8-day moving average above the 21. Looking for pullbacks to the 8 as an entry point, rather. You know, so many people see a big red candle down and they're like, "Oh my gosh, the bottom's dropping out." You have to reverse your thinking. A big red candle down actually takes sellers out of the market, and so yes, we could have follow through to the downside, but I'm looking for pullbacks to get long, not breakouts to get long. So there's a big difference there, and it's a somewhat mental shift. So many new traders, they try to chase the breakout, either the upside or the downside, and that's you've already missed half the trade by the time you enter if you're trading that way. So I don't know if we have any more questions here. I don't know. Yeah. Yeah. So I know we have Ron Bertino on the line here, or at least I think we do. Yeah, Ron, I don't know if you feel like chiming in at all. You're a pretty well-respected guy in the options community, and love to have any feedback you want to give us if you're feeling like it. Hate to put you on the spot.
Hey, can you hear me?
Yes.
Hey, yeah. Look, I've seen people trade in this kind of style where you say, a mixture of art and science. And if you're successful, fantastic. All I would say is, I guess personally, I've moved more through to the science part, and that's just been my personal evolution through the years. And part of the reason for that is because of what I consider to be the effectiveness of speed. And what I mean by that specifically is that, for example, if you were to show, like you showed a couple of candlestick setups, there's entire books that I've purchased and read many years ago that get into huge amounts of detail of this particular candlestick pattern, even if it's sometimes it's a single candlestick, sometimes it's a combination of 3 or more or whatever. And when it comes down to speed, it's super useful these days that we've got access to technology that we can very quickly plug that in through to a backtesting system and then say, show me if this thing is effective or not. And I can spend literally 3 minutes doing that and press a button, and I now get a full report letting me know that that specific candlestick setup that the book or the guru on the internet or whoever has mentioned, this is the backtesting results over the last 10 years. And then the majority of the time, when you then look at that, you'll find that the performance is horrible. And therefore you say, okay, well, therefore, if I was to have traded just this signal, then my performance would have been just as bad or worse, because then you've got slippage and you've got, fat finger mistakes and whatever to add to that. So that's what I like. I like the ability to be able to very quickly test a setup without having to, either paper trade or live trade and lose money over a long period of time. And sometimes I've wasted literally years following a guru because of the fact that his style was semi-art, but he was effective. That was the thing that got me. I'm like, damn it, how is this guy able to be successful? And you see him consistently be successful, but then there's this art thing. And I said, okay, well, he doesn't know how to teach it in a systematic way, so I'm just going to try and watch him to try and figure out what those things are. And sometimes I've wasted years literally doing that, and unsuccessfully, by the way. At the end, there was no systematic method. The guy just had a natural gut feel for when was it a good time to enter and when was it not a good time to enter, but there was no systematic process behind it. So I found that very frustrating. So that's why I kind of gradually then moved over through to more of the so-called science part and left the art part behind, because of the fact that we've got access to tools that enables us to very quickly test stuff out.
And we don't know how.
Sir, I can't hear those comments right now.
Yeah, we heard you.
We can hear you.
Okay.
We can hear you, but everybody else.
Yeah, sorry, Don's voice is all muffled. We can't hear it, so I'll mute myself out if you want.
Okay. Yeah, great.
Anyway,
let me try and turn that. Huh? Wait, maybe who? Thank you very much.
Yeah, I'm not sure how to do that. Well, yeah, Ron made some good points, and that is, essentially that this may be hard to replicate what I'm proposing. That this is not unlike so many gurus you'll meet on the internet, and they claim to make money, and they probably do make money, but is their method repeatable? And so I don't know about that. He might very well be right about it, but I've done well with what I'm presenting, and I'm sure some of my success is got to do with 15 years of doing this full time. So if you get enough screen time looking at candlesticks, you're going to develop a certain gut feeling with what you're seeing, and also these other indicators as well is very very time intensive. You need the screen time, and is it transferable to other people? Maybe, but Ron's got some good points. What I'm kind of proposing, very difficult to back test this. Maybe you could come up with some rules to frame the decisions, but Ron makes some good points. I see both sides of it. I have done plenty with 20, 40, 60 and made a lot of money with it too, but ultimately I felt like I had too much money on the table for too long, and so that's why I've gravitated to this this way of doing things. But Ron makes some good points. No,
Hello.
yes,
I'd like to add that there are also certain uses of well-known indicators that give you a much better directional information. Okay. So you talked about 821. There are 821 is very good, and you pointed out how support is there on the 8. You will see that even more clearly on weeklies. But one of the best things you could do is, see the trend on the weekly, and on the daily, you will see, beginning of a trend that is in the same direction of the weekly, and then it would be a good time to enter. But there are lots of other ways you could do, like good W patterns and so on and so forth. So there's a bunch of information on the internet. You could look at it. I wrote a book on it. If anyone is interested, it's on Amazon. But I mean, reading the chart, trying to determine the direction, is pretty much a science at this point, much more so than art. Maybe it's 20% art, but it's 80% science now.
well, that's great. JB, could you give us the name of your book? Maybe people would be
Sure.
interested.
Yeah, I try to give it away, but Amazon forced me to charge 99 cents, so apologize ahead of time. But hello. Oh,
Yes.
there you are. Yeah, let me just look it up, and I'll tell you in a second. Okay. And if you don't find 99-cent value, contact me and I'll give you your 99 cents back.
Sounds good. Maybe you could just, you tell us the name of your book or where to get it, or type it in the chat.
Yeah, I will. I'm just looking at a shorthand, and I just want to verify yeah, I got it. I'll post it in the chat.
All right.
1 second. Okay. How to read charts in trade book. There it is.
Okay, great.
So lots of good stuff.
Well,
Hope you
thanks
like
for
it.
thanks for your comments. Yeah, there's a couple more questions here.
Okay, good.
Let me see. Do you ever do diagonal credit spreads? Yeah, I have done diagonals. I kind of gravitated away from them because usually there's a sea of death on the other side of it, and I have had them like blow right through my profit tent and get into the sea of death quicker than I liked, and so really my favorite is the calendar spread because the risk reward is very nice, and if you totally screw up and it goes to max loss, usually you're still losing a much smaller amount than you might with a diagonal spread or a broken wing butterfly or something like that. So the human error here is always a factor. If I get sick, if I you know take a nap, whatever the reason is. So that's why I like calendars. If I totally messed it up, and went to max loss, I can still play the game. Let me see. Please give a bit more insight on weighted AD being used by use a longer term momentum indicator. It's really not a longer term momentum indicator. I'm looking at it moment by moment. We don't know what is going to happen tomorrow, but it's telling me what's happening today. So it's really not a longer term indicator. But the decision of whether to stay in the trade or close it, it really is a moment by moment or a day by day decision that you have to make as a trader. If you've got a trade that's getting into trouble, you're better off to go to cash than to just sit there and let it burn a hole in your wallet. So anyway, Okay, what
Sorry,
else
could
we
I just
got here?
make one more quick comment there?
Sure.
One of the things that's useful, so I've mentioned the backtesting. Most of you may think of backtesting in the conventional way of saying, this one particular candlestick or this particular moving average, or whatever, let's backtest that. One of the backtesting tools that have been mentioned in these meetings before is Mesosim. And Mesosim allows you to backtest options strategies. So you can backtest, calendars and diagonals and butterflies and broken wings and, whatever the heck you want. One of the really cool features about Mesosim is the fact that they allow you to import custom data, which you can then use as a signal. So what I mean by that is you can come up with your trading signal. So for example, you're here using the 8 and 21 in a candlestick as an example, right? So you could say, okay, if this criteria and this criteria and this criteria are met, then you would enter into a trade. So you then, the steps would basically be to export the raw data from something like, say, TradingView. You export that raw data to a comma separated value file. From there, you then suck that in through to Google Sheets or Excel or whatever. And then you simply process that to then say, okay, if these 3 items match up, then create a new column called, trade or whatever, and put a 1 into there. And when you do not have the signal to enter, you put a 0 into there. Okay, so you just do a simple if statement in that new column that says trade or don't trade. And then what you do is you then export basically just that column with the dates. So you now have 2 columns. You've got the date and time and the trade column, which has a 1 or a 0 in it, which says, would you take a new trade or would you not take a new trade based on the signals? And you then export, you create a new comma separated value file there, and you then upload that in through to Mesosim. And now the cool thing is that you can now combine those 2 things together. So you can now do options strategies, such as, say, your calendar that you're doing here, Mark, or the butterfly, but combined now with that new data, which has your trade signal information, which says, these are my favorite technical analysis indicators, and they've all said that this would be a valid trade entry today. Therefore, now when Mesosim processes all of that information on a day-by-day basis, it starts with that and says, okay, I see that I'm allowed to take a trade because I see a number 1 on this particular date in the CSV file. And therefore, now I'm going to put on a calendar that matches the criteria that you say, 100 points out of the money, 25 point wings for the butterfly or whatever, or the calendar that you're doing the 5 and the 8. And you can specify that in Mesosim as well. And now you get the ability to now very effectively run a backtest, not just on the option strategy, but the option strategy paired with your technical analysis system. And you can now do, like 10 or 15 years worth of backtesting in like 2 minutes based on that.
Hey, Ron, this is Jack.
Hey.
Thanks for the pointer. A quick question for you on Mesosim. Will it allow you to also test adjustments?
Yes.
So you can have a trade and then have an adjustment to the trade as well?
Yes. There are some limitations, but it does allow you to do it.
I love that.
Yeah. It's a great tool.
I think he was just pointing out this Mesosim tool and an approach he would use to backtest. So,
All right, that's it. Thanks.
okay. Well, thanks, Ron, for your info there. That's great.